Welcome back, everyone, to GAF University. I'm Colby Cox with Global America Financial, and today we're going to be talking about the Focus Growth Annuity from National Life Group. Now, if you don't remember the difference between an income annuity and a growth or accumulation annuity, click this link up here so that way you can refresh yourself. But if you've got it down, let's get started. So the Focus Growth Annuity is designed for accumulation. They do have another product called Focus Income. That's for income. This one's designed for growth. It's also designed for someone who wants to access it under 10 years, okay? They have another product, National Life does, called the Horizon Growth. And if you click up here, you can learn a little bit more about it. And it's designed for somebody who wants to access the money over 10 years, okay? So make sure you're deciding, depending on what your client's needs are, whether it's focus growth or horizon growth, or is it income or is it growth? Okay, so the focus growth is a single premium deferred annuity, just like focus income. It does have an immediate interest credit of 5%. Okay, so it's kind of like a bonus to their cash value, their accumulation. Okay, but it's called an immediate interest credit. So whether the first year it does anything, they're going to make at least 5% from that credit. You can have different plan options like an IRA, like a 403B. We'll talk about the crediting strategies here in a second. Just like Focus Income, this product does have a rate booster. So if the client is willing to pay an extra 1%, depending on the strategies, they can get higher caps and par rates. And again, we'll take a look at that here in a second. Issue age is 0 to 75. Minimum premium is $50K. If you have a client, that needs a product under $50K, you have to look at another carrier, or National Life does have a couple of annuities that their minimum is $5K in the state of Texas, but Focus Growth is $50, max is $1 million, and then depending on age, it might go down a little bit as you get older. Free look, 30 days, withdrawals up to 10% after the first year, okay? And then you've also have to maintain at least 5K in this annuity to keep the policy in force. You can see the withdrawal charges here. It's essentially a 9-year surrender, and that 10th year goes down to 0. Now that bonus, that immediate interest credit that they give you at the beginning, it does have a vesting schedule. Okay, so it's not like someone can come in, get that bonus, and the next year leave with that bonus. That's not the case. There is a recapture schedule, and you can see here it goes over 8 years, in year 9 going down to 0. But essentially what it means is, let's say in year 2, your client says, okay, I want to move my money somewhere else. National Life will take back 80% of that credit. Okay, so somebody can't just come in, get the credit, and then leave. That credit's going to be recaptured by National Life. There are a couple of nursing care riders that we'll talk about here in a second, and this policy does have loan features along with a death benefit feature, okay? So the Focus Growth has a legacy death benefit rider, okay? And it's optional. You don't have to have it. You can, but what it allows you to do is provide a legacy that may be greater than the money in your policy, okay? So it kind of works like the income rider, but it's not designed for income. It's designed for passing on your annuity or your wealth to a beneficiary or to your heirs, okay? For an annual fee, so you've got to pay for it if you want it. It's immediately available, so no medical required. So how does it work? It will create a benefit calculation base, and if you remember, benefit calculation base is used for income. So this product has that benefit calculation base, but it's going to be used for the legacy death benefit rider, and that will determine the death benefit for your policy. So on day 1, the BCB equals the money contributed to your policy plus that 5% immediate interest credit. Okay, so if I do 100K into my Focus Growth, I get that 5% bump. I automatically get 5K. So from the get-go, it's 105. Okay, after that, it grows annually at 7.5% simple interest. Okay, so not compounding, simple. So every year it's just going to go 7.5, and it's used for the death benefit determination only. It is not for withdrawal. So you'll have that accumulation value, and then you'll have the BCB for the legacy death benefit rider. Your BCB could be higher, and more than likely it will be higher than your accumulation value. Not always, but sometimes. And if you pass away and you have the legacy death benefit rider, that's what will go to your beneficiary. But if you decide to take out money, you need a withdrawal or a loan, it won't be based on the BCB, it will be based on accumulation. Okay, so we got to make sure that's clear. Your beneficiary at that time, when you pass, will have following options. They can get the payment over 5 years, so they'll get 100% of that benefit calculation base over 5 years, okay? Or they can get a one-time payment. They can get either the greater of 80% of benefit calculation or the accumulation value, okay? They can get the greater of either one, all right? So, like I said, this is an optional rider. You don't have to have it, but it is nice to be able to say, hey, there's a way to give more money to your beneficiaries even if the market doesn't perform as well, okay, which is a huge benefit of this product. You can access that money. Like I said, you get up to 10% without penalty of the accumulation value. And then you have the nursing care and the terminal illness rider. Beginning in year 2, a lot of this, you have to wait at least a year. If you are confined to a nursing facility or diagnosed with a terminal illness, you can access a portion of your accumulation value without withdrawal. Okay, so they'll waive their surrenders for a portion of it. So that way you can access your money to help pay for those nursing care or terminal illness needs. Okay. Last thing we're going to look at before we get into the software is the strategy. So we're looking at the second one, fit, focus, growth. These rates will affect 329, 2021, and they can change. The declared rate is 0.4, so that's a fixed rate if you put some money there. Then you have the S&P 500 Global Balance Index, and then you have the U.S. Fundamental Balance. With the S&P, you've got a point-to-point with a cap, and you got a monthly sum with a cap. Now remember, you have the standard rates or the rate booster, and if you pay a fee of 1% per year per strategy, you can get higher caps or higher par rates. So if we're looking at standard, it's 1.25 for the S&P annual cap, 100% par. But if you're paying the rate booster, it's 3. If you're looking at monthly sum, it's 0.75, rate booster 1.45. Global balanced, there's no par and no cap. So what's the difference between par and a cap? A cap is the max you could make. So if my cap is 5%, but the market does 10, I'll get 5. If the market does 2, I get 2. It's going to be that maximum amount. A par rate is what percentage do I participate in that growth. So if my participation rate is 50% and the market does 10, I get 5. If the market does 20, I get 10 because a lot of them are uncapped. But if the market does 1, I get 0.5%. So you're going to get whatever your par rate is, a certain percentage of that growth. So if we're looking at the global balanced, that par rate's 30% standard, 75% rate booster. So on standard, if the market does 10, I'm going to get 3. On rate booster, market does 10, I'm going to get 7.5. And then with the U.S. fundamental, very similar to the global balance, 30 and 75. Like I said, the rider, legacy death benefit rider is optional. You can have it or you don't have to. Okay, so now what we're going to do is we're going to get into the software and show you how to illustrate it. Okay, so here's the software. We've got the focus growth annuity up. We're in the state of Texas. Let's just say we're going to move some qualified money over. So we'll put an IRA. We have our client here. I'm just going to change their age to, let's just say 60 years old. I'm going to keep it male. Keep it pretty simple. The focus growth illustration software is pretty simple. There's not much to it. Right here, we're going to put our premium because, again, it's a single premium. So I'm just going to put $250,000. And then here we have our strategies. So we've got the declared of 0.4. I'm not going to put anything there. And then you can see we have the standards and the rate boosted ones. At this point, it's really up to the client. What's their tolerance? Are they willing to pay a little bit to get some more upside? Are they very risk sensitive and they don't want to pay for it and take away a little bit of the upside, but then they don't have to pay for any fees? Because again, this is an index product. They're not going to lose money when the market goes down, but when the market goes down, product's going to be zero, so they're going to be charged. So if they have a rate booster, they're still going to be charged. It's going to look like they lost money, even though it's not necessarily the case. It's just they had to pay for those riders, whether the market made money or not. So I'm going to say we have a client that doesn't want the rate boosters. They just want to diversify. So I'm just gonna do 25% in all of these. There's no rhyme or reason to it. It's just for illustration purposes. Okay. Like I said, we've already gone over the different strategies. Let's do this. I'm going to change these to 15 because these have caps while these are uncapped and it's par rates. Let's do that. If you need a reason for why I'm doing my strategies, I'm going to go ahead and just say the ones with caps I'm going to put less, the ones with pars I'm going to put more. Okay, that's pretty much going to be what I'm going to do. We scroll down. Next thing is legacy death benefit rider. Let's just say this, hey, the client wants to pass this money on and they want to have the chance to give more to their beneficiary. So yes, they don't mind paying that fee to be able to give more money to their family. And then here's withdrawals. You can put some. I usually don't. I'll just go to the accumulation value and say, hey, here's the accumulation. This is how much you can take out. Okay. You might have RMDs if you hit that age 72, but at that point, we can focus on that when you get there. If you're in your 60s or 50s, you don't necessarily need to focus on your RMDs at that moment. And that's it. You can click here to quick view, but what I like to do is click run report. So I'm going to run report and we're going to show the actual illustration. All right, so here we have the actual illustration. Okay, this is something that you would show the client to show them how the product works. And we're just going to scroll down, obviously prepared for the client, presented by me. Okay, we're just going to scroll down. These first two pages are the summary pages. Now, it's not that I don't like them. I just like to go to the year-by-year explanation to give the detailed hypothetical of what it looks like. So you can use these if you want. I like to go down. So that's what I'm going to do. I'm going to go down. Right here, we have the allocations, the guaranteed rates, the current caps, the current rates, which are caps and pars, and then what's the charge if there is one. Okay, so again, it's important to be able to show them that and be like, hey, this is how we're breaking it down for your illustration. If you want us to change it, we can, and we will, but this is just what we're looking at right now. We keep scrolling down. We've got some introductions to the product. Here is the withdrawal charge. We then also have the recapture schedule. So everything's black and white. Here it is. Here's how it works. This is what's going to happen if you do this. And we keep scrolling down. We have some definitions here, more definitions, more crediting strategies. What are they? How do they work? Which we've already explained to the client. Here's how the legacy death benefit rider and how benefit calculation base works. So if you remember the focus income illustration, it pretty much has the same thing, but it's designed for income. This one's for legacy death benefit. And then we keep going, and here we are at the hypothetical guaranteed. I like to show guaranteed because guaranteed is the worst case scenario. If the market from this point forward does nothing, what does it look like? This is it. Okay, so remember, you're not losing money, but you're paying for the legacy death benefit rider because that's in this hypothetical scenario what the client wanted. Okay, and so you can see right here the policy charge. That's for the legacy death benefit rider. You can see right there the immediate interest credit of 5%. Boom, that goes into effect. And then on the far right, we have the legacy death benefit rider values and payouts. So notice you've got the benefit calculation base, and it keeps going up because it's rolling up at a simple 7.5. You have the guaranteed 6 payment death benefit if that's what your beneficiary decided to take. And so if, let's say, you pass away in year 10, and you've got that $459,000 in benefit calculation base, and you have this rider, your beneficiary can take $76,563 over 6 years. I'm sorry, over 6 payments, or they can get the lump sum of $367. It's up to them. Okay, do they want the lump sum? Do they want the payments? More than likely, the payments are gonna be more because it's the full benefit calculation base. But they do have the option to take the lump sum if they want the cash up front as well. Okay, so at that point, it's up to them. It's not going to be up to you. It's going to be up to that beneficiary. But you can see here in the accumulation value, it just keeps going down. The cash value, the guaranteed cash value does go up a little bit, but the accumulation value continues to go down because we're not making any money, right? And we're paying for those fees every single year. So that's guaranteed. And then we can go to the hypothetical. Hypothetical shows most recent 10 years of how the market and how this product could perform. So you can see here we have the annual effective rate. And the first year it's 7.1, which looks great, but you have to remember that includes the 5% credit at the beginning. And then we pretty much hover between 1% and 3% from that point forward. It's not fantastic, but it still does something. Someone who just wants to keep their money safe, this might be a great option. Someone who wants to take advantage of the legacy death benefit rider and then decides, you know what, I don't want to touch this money so I can take advantage of that rider. This could be a great option. National Life's a very conservative company. Okay, so yes, although there are carriers out there with higher caps and pars and whatnot, National Life's been around a long time. They've been doing this for a while. I would trust them. Your client would trust them because they've been around for so long. So just because the caps and pars are a little lower right now doesn't mean in the future they will be. Okay, caps and pars change all the time. depending on what's going on in the world today. Okay. Again, you have the legacy death benefit rider. It looks the exact same because it works whether the money market's making money or not. But you can show them, hey, let's go to year 10. You've got a projected $275,000 of accumulation value. You can take up to 10% without penalty. So you could take $27,000 out. Boom, here you go. Here's your money. Pay your taxes if it's qualified. Okay. And that's your money. Do what you want with it. Okay. Now, then after that 10 years, that up to 10% goes away. All right. Because again, it's after year 1. And if you go 10 years, you got no more surrender. Okay. So you can take out more. You'll just again have to keep paying taxes on it. All right. And that's pretty much it. It keeps going to older ages, but it's pretty straightforward, pretty simple. There's not a whole lot of confusion to it. It's, hey, here's your money. Here's what it's going to make because it's a growth product. Here's your legacy death benefit rider. Here's how it works. Here's what will happen. Okay. And that's National Life Group's Focus Growth Annuity. If you have any questions, please make sure you put it in the comments of this video. Send us a message. Make sure you subscribe to our channel so you don't miss any future videos, and y'all have a great day.